Hello everyone and welcome to the first video of phase 2. Now in this video we're going to understand what an order block actually is, and we're going to understand the foundation of our strategy, and we're going to understand why we trade the way that we do. Now, as explained in the liquidity video, there's some moves that may appear random but they are completely legit and they fully make sense once you understand what's actually happening in the market. Now, as you know, that institutions and banks, they have a lot more money than us as retail traders, so they are able to move the market to their preference. Okay. Now, as I mentioned about grabbing liquidity, when as I said, we can't have too many winners, right? We need to have losers for there to be winners. Okay. Now, essentially, what tends to happen is when you tend to form a range, or when you have this random push down or up depending on the structure, right, and then suddenly you see some massive impulsive moves going to the opposite direction, that is probably the best indication that the institutions were involved. Okay, now this is in a very basic way, okay, because we need to understand it in a very simple form, because all we need to understand is what is going on. All right, now in terms of here, so this is a very basic scenario. Okay, so what we have our support, we have our resistance, and then what we have here is we have this push down, okay, from here to here. Okay, what's this done? It's grabbed liquidity from these lows. It's grabbed liquidity from the people that are trying to sell on the breakout or buy on the support, right? And it's grabbed that liquidity and it's gone. Okay, that was the desired direction to go. Okay, now the interesting part is why this retrace actually happens. Okay, because the interesting part is this is where we are going to be entering. Now, why is that? So for this to happen, okay, institutions and banks, they need to sacrifice a position to trade this down. So essentially, they need to place a sell order, sell position to sell all this down to grab that liquidity. Okay, so say for example they place a sell and it's here at what, say 50 million for example, and they go up here, they place their buy orders and they push price to where they wanted to go once liquidity has been grabbed, and they're sitting here at plus, I don't know, say 150. These are just random numbers, for example. However, they still have these sell positions open. Okay, so once they're up here, they're going to be sitting in drawdown, right? So they're going to be sitting in drawdown of minus, say is minus 150 here as well. Okay, so what they need to do, they need to mitigate their losses. So what they do, they push price down, down, down until they've mitigated their losses, and then they continue the move. Okay, and so as a mitigation, that is the footprint that we are looking for. This exact model is all that we are looking for. Okay, we are trading the footprint, so we are trading the mitigation play that is happening when they are going to mitigate their orders. Okay, it's very, very easy to it's very easy to understand it in this way, and they're quite easy to have like set rules on as well, which we'll explain in this video. So what tends to happen is, for example, when you have a buy move, the order block is the last bearish candle, in theory, the last bearish candle before the bullish push, and it's the vice versa. So if it's the other way around, it is the last bullish candle before the bearish push. Okay, now for an OB, we have some rules. Okay, so for an OB has to break structure. That is the must. So for example here, okay, we've broken structure. That is rule number one. That needs to happen for there to be an OB. Okay, we have other optional extras. However, these are what increase your probability when we're looking to trade. Okay, one of them is grabbing liquidity. For example, we have this support level here, so it's grab liquidity here. Okay, so that is a confluence in its own. Okay, the next one is mitigating previous OBs, and we'll understand this a bit further when we talk about order flow. But say for example we had a previous OB here, and it's only gone and mitigated that loss, their losses here, and price is gone. Okay, so this has created an OB, it's mitigated previous OB, it's also a grab liquidity from here, extra confluence. And remember in the very first video we spoke about candle volume. So in terms of the body, this will tell you where the mass collection of orders essentially are. So sometimes if you get one with very big wick but very little body, there's not really much volume, trading volume in that candle. Okay, but we don't really focus on that too much because there's ways of refinement that help us improve how we're going to trade it. Okay, so in this scenario, what we have a breaker structure. Okay, where is the OB? So essentially price needs to come down and mitigate the sell orders, right? The sell orders are the whole position from here to here. Okay, so a refinement in its own is finding the very last candle, so the last bearish candle before the bullish push, and that is your OB. Okay, that's your OB. However, sometimes price can just come and react from anywhere in that whole sell move. Okay, because they just need to mitigate, or they need to either mitigate at break even or take a small loss. Okay, it's we can't really determine on how they actually do that. Okay. So, in terms of OBs, the reason why I'm saying that it's not always the last bearish candle before the bullish push is because of our refinement. Now, as we know, inside a candle, there are various other candles, right? So, inside this candle, say this is the 4 hour, we have 4 1 hour candles, and inside that 1 hour candle, we have several other candles, right, from other time frames. And this process of refinement is how we get our stop losses so tight. So now that we understand what an OB actually is, now in terms of refinement, this is where it becomes interesting, because for example, say that this is, I don't know, say that, okay, we'll go down here. So say that candle is 40 pips. Okay, and it's the 4 hour OB, right? And then inside that 4 hour OB, we have on the hourly time frame, we have 4 hourly candles, and now we refine that OB to 20 pips. Okay, on the 1 hour. Okay, so the OB is this candle here, but inside that 1 hour candle, we have 4 15-minute candles. So that makes this now a 10 pip range on the 15-minute, and then you can keep going. You can keep going as long as you like, really. So within that 15-minute candle, we have 3 5-minute candles, and that makes that a 5 pip range, 5 pips and 5-minute time frame. Okay. Now, how this actually works, so within this, so I'll show you some chart examples after this, but within this candle, we know that there's several other candles inside. So remember in the first video when we want to understand where the buyers and sellers actually are and where they originate from and so on. So within this OB, we've got a smaller OB, which is the last sell order before that push up that happened here, right? So they need to mitigate where this sell order was. Now, as I said, sometimes over refining can be a problem because, you know, price doesn't always have to go to the extreme refinement. Refinement is something that we don't really have a rule base for. Refinement is something that's a personal preference. However, when we talk about entry methods, you'll understand how far you need to refine and how much you're comfortable refining, okay? Because sometimes you don't really need to refine too much. Sometimes you can trade straight off the higher time frame because it's a bigger range, right? Because as I said, for example, here price can react to anywhere in this whole sell move down before that push up, right? And same thing inside this 4 hour candle, a price can react to anywhere here. Inside this candle, price can react to anywhere here. Inside this candle, price can react to anywhere here, okay? And it keeps going. So what we need to understand is we can refine to as far as you like, but essentially you're looking for where the last sell position was before the buy, and you're looking for where the last buy position was before the sell. It's as simple as that. However, there is other ways to refine. For example, say we had this 4 hour candle here, okay, just before the push. Actually, you know what, I'll draw it on this one. So let me move these two here, and say for example you have one of these candles here. Now when you have your OB, right, and you want to refine it, so the OB itself is this candle here, okay. However, sometimes you don't need to go to different time frames, and this can reflect on any time frame that you wish to use. If the candle next to it, or even so on, if you have candles within the OB range, you can use that candle as your refinement on its own. So say for example, say if this is 10 pips, you can refine it down to 5 pip range just purely by using the next candle. But it has to be within the candle range, including the wick, okay? So it needs to be within this range. So say even if it was like this, for example, this is a different scenario, but I'll explain. But even like this, that would count as a refinement, or even if it was just like this, that would count as refinement, because in terms of, as we know, in terms of every candle, we have buyers and sellers in each candle, right? And we know this is the OB, but there's still selling pressure in this candle, right? So that's another form of refinement without having to really go through the time frames. And exactly the same thing, it doesn't matter what time frame you're on, you can use the next candle as long as it's within your OB range, right? Now we have another form of refinement which is quite interesting. So for example, when you have your candle like this, I didn't mean to do that, sorry. So you have your OB here. Yeah, we'll keep it as that for now. But remember when I said sometimes you can get candles with very big wicks? So let's make that a bit thicker. There you go. And there you go. So as we know, when you get a big wick, what's actually happening? Okay, so when price opens, the sellers are getting exhausted and the buyers take over with high momentum. This in its own, this wick is an OB. However, we have one rule for this, one major rule for this, which will completely invalidate it if it's not there. It has to grab liquidity from the previous candle. So how this works is this wick, okay, and you always need to look to the left, okay, it's always to the left, it's never to the right. This wick needs to grab liquidity from the previous candle, which it has taken here, okay, and then we have that impulsive move. Even if it's on the candle, even if it's on a bullish candle next to the OB, is this wick is still a refinement. So for example, say that OB was 40 pips and this wick is only 10 pips. That's a refinement on its own, okay? So just bear that in mind. So what this is called, this is what we call a wick trick, okay? And this form of liquidity grab is what we call a LG, which is liquidity grab, right? So that's what we call our wick trick. So that's another form of entry. And again, this can be used on any time frame that you use. We also have other forms of refinement. But the question is, where will price react? Because remember when I said in this diagram here, we are looking to trade this, okay? We are looking to trade the mitigation of their orders, okay? Well, where will price actually react on the order block? Okay, it can react in two places. So for example, this is our OB. Price can either react at the open, so let's include the wick. Now for me I include the wicks. Some people don't, some people do, but for me I prefer using the wicks because there is still potential, there's still price moving within this wick. So for me, price can react either to the top of the candle or to the 50%, and the 50% when you draw it is going to be including, where's my fib? There. Is going to be including your wicks. So let me get rid of the extra stuff. which is from the liquidity video. There we go. Okay, price. Oh, I almost got that correct. There we go. There we go. So price can either react at the top or the 50%. Okay. We also have the other way where when you have a wick trick, okay, price can react at the base of the wick or it can react at the 50%. So when we look to trade, we're either going to look from the base or the 50%, or from the top of the OB or the 50% of the OB. It's as simple as that. So we're looking to trade the mitigation of that, or of that, of this, or of that. That's essentially what we're going to do. And when we talk about entry refinements, we're going to understand how we're going to catch these moves with even tighter stop losses to improve our odds on this. So lastly, we want to talk about the third rule. I think it was a third rule that I wrote. I'm pretty sure. Yeah. So lastly, I want to talk about volume. So in terms of volume, what we talk about with volume is when we get a candle like this. So say this is your bearish candle, and in terms of the wicks, it's quite small. When you got a candle with a lot of body with very little wick, okay, that's an OB. Okay, so say this candle is this one here. This is probably your best bet of which candle to use when you're using an OB. So if you see a candle with a lot of volume, this is probably this should be your preference, as opposed to one that looks like that. Okay, because there's more volume in that candle than this one. Okay, it's pretty much as simple as that. So in terms of candle, in terms of volume, in terms of that rule, essentially you're looking for a fat candle, essentially. Okay, in terms of mitigating previous OBs, we will discuss that further in the order flow video, which will be in this phase. It will make more sense then rather than me explaining it now. This Euro USD chart that we spoke about before. Now, what we're gonna look at is this specific area here. Okay, so what we know is obviously this was the impulsive move. Okay, so this was the impulsive OB here. So that was the official OB, this candle here, that grey one, and this one is our refinement. However, we can refine it even further. All right, but that's only our intent. Okay, when we talk about entries, it'll make sense how we could potentially have entered here. It will make more sense then. But this is just to show you and represent how OBs actually are. Okay, so here what we have our first break, because we have our breaker structure, which is here. So we have a breaker structure here. And then we have our rule number 2 from our next breaker structure. We go back where it came from. This is the last. So here, when you get this situation, so sometimes this can be confusing. So in terms of using the last bearish candle before the bullish push, we want to use it at the extreme. So when we understand our ranges, so we got our low and a high, we want to look for the lowest, basically the lowest candle. The reason being is because for pricing to work, okay, you want to make sure that you want to buy or sell from 50% from, so if you're buying, you want to buy from below 50%, and if you're selling, you want to sell from above 50%. That's a very generic rule. However, we don't need to think about that too much, because in terms of premium and discount pricing, we don't need to think about that too much, because you don't want to confuse yourself. The thing is, the rules will force you to use the extremes. However, make a conscious effort to focus on where price originated from, because that is most likely where price is gonna go and react from, which is exactly what's happened here, right? So in terms of the extreme, we got our extreme here. So that's our low, that's our high. We got our OB actually here, and it's quite a good volume candle. However, it's quite a big wick. But however, in terms of refinement, without doing anything else, we have this. Where's it gone? There we go. We have our wick trick here. And that's essentially where price has reacted from, right? There we go. That's where price has reacted from. So it's reacted from this OB here. Not only that, we could have refined it even further by doing 50% of that. So for example, say if we traded straight off here. Okay, let's go from the OB itself. We go to the OB and we want to put our stop losses below the low, okay? And this is only on the 4 hours, so there's no refinement at all. This gives it a 55 pip stop and is only a risk reward of 1.55, okay? Making a small move to just using the base of the wick, okay, that makes it a 1.2, a 2.52 risk to reward, okay, and a 40 pip stop. And if you make it to the 50%, that drops it and makes it to a 1 to 5 with a 21 pip or 20, let's say 22, let's make it as a whole number, a 22 pip stop loss, for example, okay. However, there are ways we can refine this even further, okay. So inside this wick, as I said, we can probably find further OBs. So let's go through it. So let's go to the 1 hour, and there's no fixed way on how to do this. Essentially, there's so many other time frames that you can flick through. You can type the time frames, but you want to find a candle that fits your criteria, right? And generally for me, I like to have a nice volume candle, okay? Or if I see another wick trick inside this, okay? So inside the hourly, I mean, you can refine it down to this one. There's still really nothing, but remember, it still needs to make sense in terms of the OB rules, okay? But in terms of this, I mean, it doesn't really make it much of a refinement. Let's go to 5 minute. So on the 5 minute, if we can see here, we can refine it down to this. At the extreme, the last bearish candle before the bullish push actually happened, okay, and we can see the momentum in the way that price has moved, okay. Now momentum is measured in a very simple way. You can either count the candles, or you can look at the steepness in price compared to this sideways movement and compared to this upward movement. That's how you can compare where the momentum is sitting in the market, okay. And we're also going to talk about imbalance in the next video, which will make sense why this OB would make more sense. I don't know if price reacts here or not, but this is probably the best refinement we can have. I mean, you can even go lower, for example. The issue is, as I said, the lower we go, the more at risk we are of missing the trade. For example, this is the 1 minute time frame, and inside here, I mean, we can refine it to this candle, which is fine. However, in terms of where the volume is in this candle here, in terms of the OB. So you can either refine it to that, or if you want to, you can refine it to that. However, over refinement may not play in your favor. Just bear that in mind. So say, for example, if we refined it to this candle, or where the 5 minute was. So I'll mark the 5 minute as well, because judging by where it looked like it reacted to one of these. So that's the 5 minute open, not that one. There we go. Let's go to the 4 hour and we can see where it's reacted from. So yeah, so it's reacting to the 5 minute open. So it didn't go to the complete refinement. So that's where it's a good example of how over refinement can lead to you missing the trades. However, as I said, when we start talking about entries, there's ways that we can help. There's ways that we don't need to refine too much, and the ways that we can improve our win rate and increase our risk to reward as well. Okay, but let's just have a look at that compared to. So, for example, if that was, let me place the order here. Stop loss below that OB. In terms of stop loss placement as well, you'll learn that later on in the course. What I suggest is make sure that you complete all the phases before jumping to the chart. So go phase by phase and practice each topic. So, for example, we aim for this high. Okay, so just by doing that, so let's just make it 10 pips if I can. Okay, you know what? I'll type in. There we go. Just from making that small change, we've gone from a 1 to, I don't know where it was, a 1 to 1.5 to a I mean, a 10 pip stop, a 1 to 12 risk to reward, just by making that small change.